a revenue. No? It is like an advance which you are receiving.
It is like an inventory.
No, it is like an advance money which is received, right?
Irrespective of the customer engages in or not.
See, it can't be because you are actually buying an obligation of somebody, right? When you are buying an obligation, you are getting money out of it, right? So you have on one side a liability, which is an obligation. On other side, you are having an money which is received or receivable. So that is your asset. So when you will account it, you will be able to account only when you will render that services or render the services or goods. So in this case, it will be managing those points and rendering, then finally giving the goods against encashment of the points.
Way of looking at it, this is just without thinking. Maybe can we do a present value and then we try
No, I don't think here we will be able to do present value because on the basis of the present value only you would have given the money, right? You would have taken the money. Because when you are entering into a transaction, it is presumed, when it is on an arm's length basis, that is the present value, that is the fair value. When that is the fair value, as such you will not be able to account it. Otherwise, your obligation will need to account immediately. That's not a revenue.
which is also not a revenue.
That is not a revenue. Yeah. No, so here basically it says that you will recognize revenue only when that points are encashed. So you know that cost of those points will be 30 paise, but you will have collected from that another person 40 paise. And that then 10 paise as a profit it will come when actually you are encashing points are or when they finally elapse. So there are two ways. Some people are taking when it gets elapsed. Some people take into account at the time of booking of revenue only that I am estimating that only 80% of the points will get encashed. And that takes into account in the booking of revenue. But sometimes some people are saying that when that 1 year expires, then that balance 20%, if at all, it will be taken. So both way I think is fine.
That might have been factored while deciding the consideration.
No, so you would have factored in, the challenge will be that if this estimate goes different, then here at every point of time, if you are reporting, at the end he is reporting there, you need to estimate. So that estimate will get changed, then you will get a charge or revenue at that point of time. So we have discussed this definition of consideration allocated to award credits. So this is on the basis of fair value. I think we have discussed this. So gain is also income, but it's not a revenue, right? Because the gain in the definition of income is comes. So income includes both revenue and gain, and that is why any gain which happens, you will not take it on a revenue line item. That is the only purpose here. And revenue recognition policy has to be clear. Just saying in a simple term that this can involve when it is transferred, revenue will be recognized. Most of the present balance sheet, the present financials are saying that this will not be enough in case of IND-AS scenario. We need to describe each and type of revenue and what decisions you have taken. I think you need to describe that. I think gap difference is really a problem. But basically, I just want to mention that there is a IND-AS 115 which is already there. Internationally, IFRS 15 got deferred, and that is why there was a debate with the institute. In fact, institute earlier were feeling that we will go by the upgraded standard which is there. However, if you look at certain aspect of these standards, it is not yet clear that how certain things will get accounted, and it is likely that if US need to adopt IFRS, there will be a changes in this standard because the US standard has a lot of rules on accounting of revenue, and that they would like to incorporate. Otherwise, they would not like to adopt this. So that was the biggest challenge from ISB point of view also, and that is why they have also decided to defer this. And if we will do it now, and if fundamentally if something is getting changed, so finally it was decided by the institute that they will come out with the two standards, that is IND-AS 11 and 18, and that is how now we are in their data. Although here it is saying that it has been postponed to 2019, I am not sure that from 1st January 2019 this standard will still be applicable. So we need to wait and watch for it.
Yeah, as we speak, the International Accounting Standards Board is conducting what it calls people's views and comments and commentaries. They're collecting, so it will take some time. But I believe the recent US, because of international accounting, they want it to happen as early as possible. That's what they say. But they've deferred it. So by 2018, if internationally they accept it, probably we should be there by 19.
Yeah, that's right. So internationally also it will be, but I am not sure whether internationally.
Nobody is sure about it because it's a real dangerous proposition that they are giving. It's quite detailed.
Correct.
It took almost 6 years for revenue.
Right.
Because of convergence, see, they're trying to make it common for US also. That's why.
And I'm telling you, if you look at the US GAAP, you won't be able to make it so convergent. It's impossible. US GAAP has so many literature on that and sometimes I find that there is no good logic. So conclusion may not be
different standards.
correct.
But I think the answers are all there. If you go to see.
Yeah. I agree that answers are all there, but you can argue otherwise also.
That's the fight between rule versus principle.
Right. So there it is rule based, so there are answers which you will get.
So rule based means they break more rules,
Yeah.
so that is why major all the accounting standards also come up there.
They get bought. They
So-
get bought. The rest of the world they don't get bought.
No, because they themselves only specify, so it is easier to pinpoint than catch.
So basically, I think this is the last slide which we will take it here. In 115, these are the 5 steps which are given. Basically there, it is based on the first you have to identify the customer, identify the performance obligation, determine the transaction price which will be based on the fair value price, allocate the transaction price to the various performance obligations, and then recognize revenue. So here basically it says that revenue can be recognized at a point of time or over a period of time, and that is where these 5 steps you have to go by those steps and then only work out that. So we will not go into detail, but I thought so here what is that new standard and what is the change which is going to be there from this IAS also has been given. So one can just look at it for this, just for the information purpose. Okay.
Do you want to touch upon gross versus net just a little?
Yeah. Yeah, so basically gross versus net is a major thing which is there, and when we will be able to account it on a gross basis is always a challenge. So again, you have to go by a different numbers, and you need to look at it that generally discounts and rebates which we are talking about. Many times, it may be your own particular product which you will give, or your product which is manufactured, then in that case definitely we will do that. But if you are giving certain other material also, it may have to be made on a net basis. So basically what it says is that when any discount is directly linked with the sales which is happening at that point of time, you need to net it. And if subsequently if you get something, then only you can continue as a rate.
Can you tell me the example?
So in case of volume discount also, you need to estimate that this is the volume discount which you are giving, and you never.
But it will be contingent. Volume discount would be contingent. We will never know that whether that would that it would be.
Yeah,
Like an estimate.
so you need to make an estimate.
37
And
decimals.
yeah, so you need to make an estimate and then net it off on that basis, and then that will get adjusted when that finally whether that volume happens or not. At
So,
that time it will get adjusted.
Can we apply the same principles of the sale price what we have in the VAT regime to account for whether we need to account for the gross or the net? Because what is agreed as a part of the transaction, what is agreed as a benefit at a point of sale, and if that we consider, then we can net it off.
Yes.
If something is coming after the transaction has happened, then we need to cross it.
Now, the example.
No, but if it is a discount based on certain volume, then in that case you need to estimate that and net it.
The example is Gozema gave us another now there will be almost 9 to 15 streams. So how much you will do netting for each one of them or only for materials?
Which one?
You know, the Ghana.com and the Southern.com and all, there are various, I think it all depends on how do we contract, how do we embed it in the contract, the multiple contracts. Like if the
Yeah, but in Saman.com and all these cases, at least there will be 3-4 elements of contract. At least there will be a bifurcation of the
because there will be one will be the content which will come directly from say a Sony or from somebody else. Then there will be an element which what you do to it,
then you are providing the services of transferring that and all that thing also is a
Materiality we have no consider.
no.
materiality we have some consideration but not
No,
much.
I would not say materiality. I would not say materiality because for me, I mean on a general basis, I don't use the word materiality for accounting purposes. I use it from an auditor's perspective.
Correct.
So I don't use accounting perspective. Material never applies according to me because the nature of business that is more important. So for example, a Sawan or a Ghana may have 30 rupees element for one, or they also sell for 5 rupees a day. But still those elements have to be broken. So there is a system, and that person said.
See, sometimes they say that any content I will give you, but I will charge you fixed amount per day.
Yeah, that's right.
So that's also, then if that is the case, then it will go as a period revenue. Because you are saying that I will charge you 10 rupees per day, and you can take whatever you want, 100 rupees per day, and you will take whatever. So it will all depend upon what type of schemes are.
And again, you know, these companies that we are talking about, first of all, you don't know whether they are parented in India or they are parented outside the country. So there's a transfer pricing regulation which will fit into the system, whether you are a subsidiary of a US or a Cayman Islands company which is already taking the content from here, taking it there, bringing it back, service tax embedded into it. So there is a lot of game plan.
So that is why I'm saying 12 to 15.
Yeah, it is that.
One more drawback is the company gives a lot of discounts, rebates and schemes. Normally we show as a part of selling expenses. Even under IND-AS is the same treatment or so different?
So the rebates and all that.
Discounts, like trade discount or cash discount, all. We show as a part of selling expenses. We don't deduct from the sales.
No, so that is what here it was mentioned, that it has to be netted out. It has to be netted out any trade discount. In fact, in today's accounting standard also it is clear that any trade discount is to net out. Many times, you know, people give cash discount, but it is like a trade discount.
Like special
It has
discounts.
nothing to do with the policy of where you are getting the money.
Like
But they will name it as a cash discount so that they can book that in a subsequent period.
apart from trade, we have a lot of schemes like special discount.
Those are promotional expenses.
Yeah, so if it is promised at the time when the sales happens, and if you will be able to estimate, then I think you should net it.
Maybe here, see, I think promotional schemes would depend upon maybe certain how much they would be selling, and then depending upon certain other conditions,
Yeah,
you may
but-
not necessarily be able to take it off at inception.
Yeah, but so that's why you can estimate that, then you need to net it.
You just maybe how you make a provision. I think those are in terms of basically your EPS
So
37.
that's a gross versus net.
Gross versus net debate is the same principle.
So you explained about the allocation of revenues. Well, India also gives guidance in terms of whether it should be mirroring this in terms of expenses and equity.
Basically, this is only revenue recognition. So standard of how to account for the cost, there is a accounting for the cost is coming only in the construction contract.
See, there are only
Where construction contract says that based on the percentage of revenue which you are making, you need to book that one percentage as a part of the cost. But otherwise, 18 per se is not talking about how you need to account for the cost.
See, here if you look at the entire IND-AS, there are according to me only two standards which deal with any items of cost. One is the standard on employee benefits and the other is income tax. Those are the only two standards really which deal with the debit side of the P&L in the strict sense. Apart from indirect reference in terms of the construction contracts or how do you recognize your cost of goods sold when I will be covering inventory. I mean, each individual.
Yeah, but at the same time, you know, if you will look at it whether revenue and expenditure are matching.
Matching cost.
Matching concept, but matching concept is not at all now a fundamental concept.
Now
It is not a part of the framework. You cannot say that I want to match, and that is why I will not account for certain costs. That's not enough.
or certain costs you may have to incur, but that does not necessarily mean that you have to even
But
take
most of the time you will be able to say that it is like a work in progress for me. Because I am handling the services. Once the services gets completed, at that time only I will be able to do the revenue. If that is the case of a milestone basis. Or I have to, I will,
If you discuss about service and maintenance,
correct.
so you should account for it as a revenue to that extent.
Yeah, right.
But the purchaser of the software may want to, how he would record it in his books of account. He would also say the hardware is costing me and the maintenance services is costing me at each and every. The IND-AS provides me guidance on
So it is not necessary that I am booking as a seller revenue. You need to account that also as a cost. It is not necessary. Because you will go on the basis of generally PPE. If it is a asset for you, or if it is a revenue item, then you will go by the same. So see there, if it is an expense for you, okay, you will just account it and forget. Revenue, it may be possible that you may have to defer or you may have to take it over. So there is, as you are rightly saying, that there is no standard to say that how the cost you need to account except for construction. So for a project cost, definitely it is there.
So what would happen is, like we are saying, when you are recognizing the revenue, you want to show it as in terms of PI. But I want to show it as a mirror image because yes, there is for sure allocation of expenses or there is attribution in terms of the rendering of services. Revenue may want the income tax department or the service tax department may say that if you yourself are saying and the revenue is like that as PI does, and there may be some withholding tax implications or reverse charge implications, there it may not be triggered because you are not bifurcated.
Yeah, so again, I don't think we should bring income tax into the picture.
I never wanted to.
No, no, I understand.
holding my back in terms of
Yeah, so it may be possible that you are saying that you are making a revenue, but you are not paid GST, let's say, or you are not paid VAT.
which was the connected question that how far we are saying IND-AS may be compliant with the other charging provisions.
May not be.
May not be.
May not
That's
be
what I'm
compliant
saying.
with the
May not be.
direct tax provisions. There may be
You
issues.
may not make that. So you need to explain that this is what is the difference. It will create a problem also. IND-AS recommending not guarantee that is what I said, there are different standards. Okay, let's go quickly into the EIN. So this is the accounting for real estate transactions. Basically, before that, I wanted to cover IND-AS 11. But if you discuss IND-AS 11 principle, it is not changing much, and that is why if time permits only we will go by that. But this real estate transaction also it is applicable here. I want to just highlight certain points. And so in construction contract, two things I think we need to take into account. Whether it is really a construction contract or not. Okay, if it is not a construction contract, then you will not be able to apply that particular account. Okay. However, I think here I would like to mention about you may not have that. I think, so it will be something. It will be given to all. So here also, when it is talking, guidance note is talking about real estate transactions also, where it can be considered as a sale of goods or a sale of services, and how you need to account it. So when it is a construction contract, it is definitely sale of services, and when it says here that when you transfer the risk and reward to the purchaser, then it will be treated as a construction contract. However, the distinction between IND-AS 11 and what is the guidance note says is quite different, because what basically it says is that initial recognition you need to start at a much later date than what you would have considered in the construction contract. In a construction contract, you would have started recognition of revenue immediately. If let's say 5% or 7% is completed, you will book the revenue of 5 to 7% if you are sure that able to estimate the cost and revenue. You will be able to do that. But this guidance note says that when you achieve 25% of the total cost, and that is also construction cost without land, without interest cost, then only you will be able to start the revenue. Now, there are a lot of builders who is finding this particular thing very difficult. I am doing one company where it is a Bombay project. The land cost is 50%, 10% is the interest cost, and only 40% is the balance cost. So basically, on a totality basis, when it has incurred 80% of the cost, at that time it is able to start booking a revenue. And what happens is that when you start booking of a revenue, you are booking full 80% at a point of time. So it is like completing your project and then you are booking a revenue. Actually, that is not the intention of IND-AS 11 or any such standard. But because of this guidance note, one may have to follow that.
TDR would fall into the land cost or the construction?
Yeah. So when there is a TDR selling, which is done, it will be like a goods. Because what you are doing, you are just transferring your right to somebody else. So you are selling the rights, and it will be IND-AS 18 will be applicable. It will not be only whatever IND-AS 11 when it will be applicable when it is a construction contract. So here,
and if the developer is buying the TDR, then it will be a part of construction cost?
yeah, if it is buying the TDR and if it is going to utilize for its construction, then it will be a part of the cost.
Not the part of the land cost?
It can be part of the land cost also.
Can be a part of the land cost.
Actually, TDR is generally a part of the land cost. there was a contract of IFRIC 15. So this guidance note is nothing but IFRIC 15 principles. However, the threshold limit of starting revenue and all that, they have totally changed. And that is why if you will not say, you will not be able to say that this is equivalent to IFRIC 15. And some of the principles, to my mind, they are relaxed in a guidance note, because if some point of time, if you will really look at some of the terms, you are not transferring on a step-to-step basis all the deliverables or risk and reward. You are not transferring on a continuous basis. But because the main condition which is what was there in IFRIC 15 is that whether you will be able to change the design as a purchaser or not. And in most of the cases of RDLS transactions, you will not be able to change the design beyond certain minor things. And when it says that you will be materially be able to change the design, at that point of time only you will be able to say that risk and reward is transferred. Which is generally not the case here, but this is the international standard. So internationally, most of the people will have a bungalow type of construction, and in that case, definitely designing will be here. Here, when you are making a 10 floor or 20 floors, the builder will not give you any room to decide on certain designs or modify the designs. So basically, that is why it is coming as a guidance note and not as a IFRIC. The scope is, this guidance note also covers all the real estate transactions, whether it is not only when it has been sold. So as it has been mentioned, here it is also covered joint development agreement for real estates, redevelopment of existing buildings and structures, acquisition, utilization and transfer of development rights. All the type of transactions are getting covered in this. Okay, so let's go to the example directly. Developer Smart Limited has purchased a big plot of land measuring 200 acres and has a plan to develop 10 big tower buildings for commercial and residential purposes. It will have to construct a common road for movement of vehicles inside the plot. As a part of the contract, it has accepted to provide common clubhouse facilities. Generally, that is the case here now. It has also promised to develop sports and swimming facility to the member. For this, it has tied up with a third party who will provide this facility, and third party can also bring outsiders to use the such facilities after collecting charges, subject to the conditions that the outside members cannot be more than 500. Parking areas and energy backup is common for each of the set of 2 towers. It also provides additional parking space on payment of ₹5 lakhs per parking area. Jogging track and all these things are there. So it's important to note that identification of the unit is first thing which you need to do in such type of things. So you need to look at it whether on its own, if any particular unit will be able to perform, then in that case it can be considered as a separate project, although you may be building or constructing 5 towers, as it is mentioned here, 10 towers in one area. You may be able to bifurcate them and consider that as a different project. Why it is required is that if you will consider this as a one project, for first 2-3 years you will not be able to book the revenue, and that is why you have to come to a logical conclusion that which you will be able to consider that as a separate project. So here, looking at the facts, it's possible that 2 towers put together can be considered as a project, because 2 towers is having a common facility, common electricity and all that thing. So it's possible here to say that 2 towers will be one project. So first thing is to identify that what you will be considering as a separate project. That is the first thing. Project cost comprises of cost of land and development rights. It also includes rehabilitation cost if it is SRA project, registration charges and stamp duty and brokerage. So everything will get covered. Even it will be a borrowing cost, but the borrowing cost will be based on IS 16 standard, or borrowing cost standard, ES 23. Foreign exchange on loan to the extent considered as interest under 23 will be also part of this. Construction and development cost also will be part. What will not be a part of the construction cost or a project cost are general administration cost, selling cost, research and development cost, depreciation of idle plant and machinery equipment, cost of unconsumed or uninstalled material delivered at site. I think typical thing which I would like to mention here is that there are sample flags which are generally, builder will give, and that it will use as a part of the advertising. So the big challenge is that whether that sample flag which has been constructed, whether that you will be able to consider that as a part of the cost for the project or not. So I think two things you need to look at it. Whether this sample flag has to be dismantled at the end or not. If it is going to be dismantled at the end, definitely it is a part of the marketing cost. It cannot be. But if this sample flag finally, I think many builders have started selling also at the end. When they start selling at the end, then it can be considered as a part of the cost. But there can be a maintenance element in there. That maintenance element is a marketing cost, because you will be furnish it properly, and whatever you will not be able to sell at a subsequent date, that needs to be considered as a part of the marketing cost.
Even if that sample plate needs to be refurnished or re-maintained, because normally construction takes 3 to 5 years of time. So by that time the condition
so that
of
is
that
why the basic cost you can take it, but for refurbishment whatever cost which is there, that you take it as a marketing cost.
So that is the market.
That you. So here, if the agreement of sale is legally enforceable, which signifies transferring of significant risk and reward, it is considered as satisfying condition of a revenue recognition. It may be possible that the legal title is not transferred or the possession is not handed over to the buyer. I think this is what principles which is there in the guidance note, and on that basis only then you need to account it. And this is, if you will see that this is some relaxation compared to if it as we have discussed, sale of undeveloped land, sale of TDR, constructed units, all these things will be part of the IND-AS 18. So at a point of time you will be booking the revenue as if that you are selling the goods. Okay. Now, important thing is that when you will be able to book the commencement of revenue, when you will be able to start the commencement of revenue. As per the guidance note, you should have been able to, you should have incurred 25% of the cost other than the land cost and borrowing cost. That is first. Second is that minimum 25% of the saleable area would have been sold. So if you would have sold only 5% of the area, the thing is that that is not enough for you to construct everything and give it to the buyer. And one more condition which is there is that at least 10% of the contract consideration should have been received. Right? So if you have a scheme of 595, then on the basis of the 5% you will not be able to book the any revenue. Right? You may have sold the full flat, but you will not be able to book the revenue. So here only the leeway which has been given is that it may be that only on 10 percent of the total sale which has been done, you have not received 10%, less than 10%. But if you have received more than 10% in other sale of units, those units can be considered in arriving the threshold of 25%. So that needs to be kept in mind. We will just look at the example. So a hotel has sold certain timeshare at rupees 1.05 lakhs each, which entitles the members to occupy one room of the hotel for 7 days for next 5 years. How this needs to be accounted as a revenue? See, this can be compared with the sale of rooms for which the payment is received in advance. As the member is entitled to a total 35 room days, revenue will be booked with his utilization is consumed in the first year if 5 days are utilized. So if 5 days are utilized, on a corresponding basis you will take that. However, if 7 days of each year cannot be carried forward in case of non-utilization, the balance revenue will be booked at the end of that period. So that is what basically it says, that it becomes certain only at the end of the period. So POCN basis, how it will get applied? Here if you look at it, the area sold in each year is 20, 20 and 30,000. Estimated land cost, which remains the same because land would have been purchased immediately before starting of construction. Estimated construction cost is also remaining same, and total estimated cost is also remaining same. So if you look at in the first year, actual cost incurred on land is 6,000, which is the full one, and actual construction cost which is incurred is 1,500. So if you will compare with the total construction cost, it is less than 25%, because for 4,000 against 4,000 lakhs, it is 1,500 lakhs. So it is less than 25%. When it is less than 25%, in the first year you will not be able to book any revenue, although actual cost incurred is 7,500 lakhs. 7,500. So total sale consideration as per the executed agreements is also 7,500. You will not be able to book the revenue in the first year because of a threshold is not achieved. In the second year, you will be able to book the revenue. If you look at it, so and one more thing, with all this changes which are happening in the rules and all that, this guidance note says that if the critical approvals are not received, you will not be able to book the revenue if you satisfy all other conditions. I think that's quite important, which you need to keep in mind. So it is presumed that it is done. So this is for the first year. Second year, what happens is that stage of completion is coming to 90%, and that is why you will be, threshold is gone. So you have to also consider the land cost, and on that basis it is 90%. So 90% of the revenue and 90% of the cost you will go, and the balance you will carry forward as an inventory. Basically the guidance note also says that if there is a material which is purchased and not utilized for the construction, you cannot treat that as a part of the cost. You need to treat that as an inventory and not as a part of the construction cost. So once that material purchase, when it is utilized, then only it will be treated as a construction cost.
How do people import that significantly different from the AS7?
No, so AS7 actually is not giving any threshold. It only says that you should have a sufficient construction cost to have incurred that you are sure that revenue will be generated out. So generally people will start with the 5-10% of the threshold.
Normally at AS7 had 25%.
No,
20%.
No, only guidance note
opinion, guidance note had
only guidance note is there, so here it is not the
Actually, the contract will also define milestones in
Yes.
construction contract. See, there is a difference in construction contract in the sense that the person who is the contractee he will also take over the work.
Correct. So he will be, if you will not be able to supply the services, he will take over the.
He will get approvals from his PMCs or whatever.
Yeah.
This is point of if you acquire the material, if you don't use for the project.
So so that's what I am saying. That if you are not used for the project, it is not your cost. It is an inventory, and that you should not consider as a part of the cost.
How do we keep a track of that? If somebody is running say 10 projects at the same point of time, they keep on buying the material.
Yeah.
Unless and until the cost or the different project accounting is being followed. If the same project accounting is being followed, then how do we keep a track that what is?
See, generally you will keep a track because it is important for you that the material is not just getting displaced, right? So I think generally you will keep the, and you for your purpose also would like to see that what is profitable, whether it is good. Generally you will keep it.
As auditor, I will not be satisfied with income of that.
Yeah, that's
a very fundamental thing.
Even if the separate project accounting being followed, some inventory being purchased and meant for utilization for a project, for an auditor it would be really very difficult to know whether that has been utilized or not.
Yeah, so for auditor it may be difficult, but for management it is fine.
So technical estimate, engineer, somebody needs to give some sort of certificate.
See, there can be minor differences where something is lying on a land and it's cut and all that. So all that you will not take it. But whatever is as it is purchased and is kept in go down, you cannot take that into account.
How much steel you would use for the area of construction and all that. You would have some norms. You can make out.
So this is another case study on a joint development. I think in a joint development the challenge is that one party will generally bring the land and another party will construct, and then the revenue which is there or from the sale it will be shared on certain basis. So that is where, so there the accounting, so here all the details are there. Sale consideration of the area available for sale is 1,000 crore. So I am saying from the point of view of the developer who is doing it. Option 1 is that no accounting of land acquired in the JDL limited. So you will not do any accounting of the land purchase. That's option 1. Second option is accounting of land at a fair value of the land available to JDL. So you will accounting on the basis of fair value and consider as a part of development cost. Third thing is that accounting of land at a fair value of constructed property to be given to landowner. So whatever has to be given to the landowner, only accounting of land will be based on what expenses you are going to incur to construct that portion, because that portion has to be given to the landowner. And fourth one is that accounting of land at value equivalent to the cost of construction. So in my view, it is not, option 1 is not correct, because particularly in IND-AS era where everything needs to be accounted on a fair value basis, and the best option to account is on the basis of 2. So if you look at all the 4 scenarios, what you will be taking as a profit on an overall basis will be same, but percentage of profit turnover will be different because your revenue is at a different level. So in the first option, revenue is lower because you are not considering the fair value of the land. In the second option, you are considering the fair value of the land, but you are considering that fair value as if that you would have purchased that land. And in the third option, constructed property, so that also is not correct, because there you are taking only cost of construction, so your profit element which you would have expected, you are not taking that. And in the fourth option, land at a value equivalent to the cost of construction, also is not correct. So basically in the third and fourth, you are not taking some element of the profit. And that is why the second option is the best option. Okay, I think anything to particular to do with the construction contract, then I will look at it. Otherwise, there is a material which is there, which is 95% is in line with AS7, which is there. The basic difference which now they have taken is that they have introduced in some cases the fair value concept, and the concept of discounting. So the element of the finance cost. So that to that extent you need to make an adjustment, which is generally a common for any IND-AS application now. After adjustment,